Every one of these things is untrue. Every one of them, except the yield thing, which I'll come to, but they're all untrue. Let me show you why. So first of all, there's not enough gold to support finance and commerce. Well, what's the money supply in the world? If you take M1 for the US, China, the Eurozone, and Japan, so that's basically 75% of the global economy. So these are really the currencies and the economies that count. It's $24 trillion. And how much gold is there? Now I'm talking about official gold owned by central banks and finance ministries. The answer is 33,000 metric tons. How much gold do you need to back the currency? How much gold do you need in a gold standard? So if you take the 24 trillion of money supply and you want to back it with 40% gold, you need $9.6 trillion worth of gold to support that money supply. So I said there's 33,000 tons. I'm using a price of 1,300 an ounce. It fluctuates, obviously, but that's a good estimate. Comes out to 1.5 trillion. Aha, not enough, right? You need 9.6 trillion. You only have 1.5 trillion. Okay, but what if you change the price? In other words, if you raise the price to $8,265 an ounce, now the same 33,000 tons comes to 9.6 trillion, which is just right to support commerce. In other words, there's always enough gold. When someone says there's not enough gold, just look at them and say there's always enough gold. It's just a question of price. You have to get the price right. When I talked about $10,000 gold, that's my intermediate price target. It's not a number I made up. I don't pull it out of the air. I'm not trying to attract attention. It's actually the implied non-deflationary price. These are up-to-date figures, but this money supply keeps growing. That 24 trillion keeps growing. So my estimate is by the time you get around to a gold standard, which may happen, it'll be $10,000 an ounce. So short answer is there's always enough gold, just a question of price, and you can expect in a gold standard the price will be $10,000 an ounce. Gold supply doesn't grow fast enough. Well, annual mining output increases about 1.6% a year. World GDP grows about 2.9% a year. Aha! Is it true? The gold supply doesn't grow fast enough to keep up with the economic growth. The answer is no. Again, this is nonsense. And the reason is that in addition to the 33,000 official tons, which I just talked about, there's about 150,000 tons of private gold. And if a central bank needs more gold to support the money supply, all they have to do is print money and buy it. In other words, you could set your gold hoard at any level you want just by printing money. And by the way, this is exactly how the Fed increases money supply. What they do is they print money and buy bonds. It's called an open market operation. Well, there's no reason you can't print money and buy gold to get gold, and then with a 40% ratio for every dollar's worth of gold, you could have $2.50 of money supply. The limit on mining output is irrelevant. It's irrelevant because you can always buy private gold with public money and increase your gold supply and support any level of economic activity you want. So this one doesn't hold up. Gold has no yield. Well, this one's true, but it's not supposed to have a yield. Gold is money. So gold has no yield, but a $100 bill has no yield. Reach in your wallet, pull out a dollar bill, Canadian, US, whatever, and look at it. Does it have a yield? No. It's a perpetual non-interest bearing liability of a central bank. So it's money though. It is a form of money. It doesn't have a yield. Money doesn't have a yield. People go, oh, well, I get a yield on my money. I put it in the bank. When you put it in the bank, it's not money anymore. It's a deposit. It's an unsecured liability of an occasionally insolvent bank. People go, I have money in the stock market. No, you don't. You have stocks. I have money in real estate. No, you don't. You have real estate. I have money in bonds. No, you don't. You have bonds. In other words, if you want to convert real estate bonds or stocks into money, you got to sell it. And guess what? When you go to do that, probably everyone else in the world is doing it at the same time, and your money's disappearing, so-called money, before your eyes. So real money doesn't have a yield. It's not supposed to. It's a unit of account. It's a store of value. If you want yield, you have to turn it into something else that has risk. You don't get yield without risk. Money's not supposed to have risk. Gold has no risk. It's just gold. You put it in a drawer, go back 10 years later, it's still there. Hasn't changed. Same thing with a $100 bill. It's not supposed to have yield. Here's Paul Krugman's favorite, as I mentioned, gold caused depressions and panics. Well, during the gold standard, particularly, through basically all of human history prior to recently, there were lots of financial panics. Just in the history of the United States, I listed some here, 1797 and so forth, 1929, were all panics. But the point is, when we went off the gold standard, we also, we also had financial panics. And I listed them there, 1973, the oil crisis, 1980, Latin American debt crisis, 87, the stock market fell 22% in one day. If that happened today, by the way, 22% would be the equivalent of 5,000 points on the Dow Jones. You know, if it went down 500 points, that's all you'd be hearing about. Imagine going down 5,000 points. That's what happened on October 19th, 1987. And the point is, the gold standard has nothing to do with panics and depressions. They happen with a gold standard, sure, but they also happen without a gold standard. Financial panics are psychological phenomena. They have nothing to do with gold. And so this is just another one of these false red herring arguments people throw out there. So panics happen with or without a gold standard. The gold standard is irrelevant to the issue of whether you're ever going to have a financial panic. It has to do with leverage and psychology. Gold has no intrinsic value. Actually, it does have an intrinsic value, but intrinsic value is irrelevant. David Ricardo was the economist who came up with the theory of intrinsic value, and what he said was, well, intrinsic value is what it costs, all the inputs, so how much labor, how much capital, how much time and effort, those are the inputs, that's what something is worth. The intrinsic value theory is true but irrelevant because it's not how we value things. And Carl Menger, founder of the Austrian School of Economics, University of Vienna in 1871, said, no, we value things that are subjective. Something is, you've all heard the expression, something's worth what someone's willing to pay for you. Go to a miner, his mining costs are $1,400 an ounce, in a very expensive mine, and gold's $1,300 an ounce. He says, I'm losing money. Too bad. I mean, nobody says, you know, his intrinsic cost is $1,400, but nobody says, well, that should be the price of gold because that's your intrinsic cost. It's irrelevant. It costs about $4,000 per Bitcoin to mine a Bitcoin, and if you can sell it for $10,000, good for you. But the fact is, these things do have intrinsic value, but intrinsic value is not what things are worth. They're worth what someone will pay for it. That's subjective value. So the fact that it does, people say it has no intrinsic value. It actually does, but it's irrelevant, and that's the point. Finally, Keynes called gold a barbarous relic. Not true. He never said it. I actually went to an antiquarian bookseller and got a copy of the 1924 book, Monetary Reform. I got a first edition. I wanted to look it up myself because this quote was very hard to track down. What he said was, quote, in truth, the gold standard is already a barbarous relic. In other words, he was talking about the international monetary system of the 1920s, the so-called gold exchange standard. He didn't say gold was a barbarous relic. He said the gold standard that we have, and he was right. It was a very messed up gold standard because it wasn't limited to gold. Keynes was an advocate for a gold standard in 1914 when he was fairly young. He was an advocate again in 1944 at Bretton Woods. So Keynes is not quite the gold basher that people make him out to be. So the point is, every one of these arguments is either not true, or if it is true, it's okay because it's obvious. Sometimes gold has no yield, yeah, but it's not supposed to. So in other words, all of the objections to gold as money fall down. Every single one of them. There is no impediment to having a monetary standard based on gold. And if you do, I'm not saying it's going to happen tomorrow. I'm saying that in a financial panic, in a liquidity crisis, in a monetary panic, worse than 2008, which I do expect, if international elites, the IMF, finance ministers of the G20 countries have to restore confidence and they turn to gold, which they might, you have to have $10,000 gold. Any lower price is deflationary. It would completely defeat the purpose. It would repeat the blunders of 1925. And so basically there's nothing standing in the way of a gold standard tomorrow.